how do we apply internal control to cash receipts and payments within a business? We'll look at some examples. So this graphic shows that none of the people involved can make a mistake or divert cash without the difference being revealed. So we have a clerk that rings up cash sales on a register, prepares the cash count sheet and keeps a copy, and sends to the company cashier along with the cash. So they have a cash sheet, who they received it from, what it was for. The cashier then prepares the cash records, deposit slip, and makes a journal entry. The supervisor reads the data, prepares the register sheet, keeps a copy, and sends both to the company cashier. So these are checks and balances that are put in place so that the cashier who is preparing the cash records, deposit slip, and journal entry has information from both the sales department and the supervisor. Sometimes we have errors and when we're making change or other errors. So there can be a difference between the cash and the cash register. So in this example, we have that the cash register's record shows $550, but the count in the cash register is $555. So we would show that we have cash over and short and record that there is a cash overage in this instance. Now, most businesses will have a threshold of what is okay for over and short to be recorded and what needs to be further looked for or what would necessitate some kind of investigation. Generally, $5 is not something that we would do an investigation for, but it was $50, we would be concerned about that and we would want to figure out why. And for a shortage, we have the same thing. So if we have a shortage, we also record it to that cash over and short. And again, that there is a threshold for what amount we would further investigate. When we have cash receipts by mail, we have that we want two people assigned with the task of opening the mail. These are just good internal controls. Those people should record what is received in the mail and what is which customer it relates to, where that deposit should go. Then a separate person, the cashier, deposits that cash in a bank. And a third person, the record keeper, would record the amounts received in the accounting records. The record keeper would just have a sheet of tallies, customers, and amounts. They would never touch the money. The two people opening the mail would touch the money, but they would keep a full record and they would check on each other to make sure that all cash would be there. Control of cash payments is very important because most theft happens when we have cash payments. And many large thefts are from payments of fictitious invoices. So we want to, one, require that all payments are made by check. Limit access to checks except for those who have the authority to sign checks. Another internal control that can be put in place is that we require two signatures on checks. We would also make a cash budget, which would project our cash receipts and cash disbursements so that we can check our cash payments against those projected cash disbursements and make sure that we're not making cash payments that we didn't plan on or have in our record book somewhere. A voucher system helps us to establish procedures for verifying, approving, and recording liabilities for eventual cash payment, and then additionally issuing the checks for those payments. So in a voucher system, we receive an invoice when we purchase inventory or supplies or other things that we would eventually have to make payments for. And then we would pay and issue checks against those. The next thing that we're going to talk about is a petty cash fund. When a business has a petty cash fund, it is a small amount of cash that they have available on hand for various things that can come up during the business hours that they don't want to write a check for or have to have a check issued for. These things can be postage, shipping fees, minor repairs, any low cost supplies. They might say, I'm just going to run to, Target because I need something really quick. We don't have time to order it from our normal office supply company. And I'm going to take $10 out of petty cash. I'm going to come back with the change and a receipt. When we establish a petty cash fund, we're going to debit petty cash and credit our cash account. We generally keep petty cash in a locked cash box somewhere in the office and have someone who has the key and is allowed to distribute funds from that box. This is an example of a petty cash payments report. So the company has these various things that have happened during the month of November. They had their tiles cleaned and they paid the person in cash out of that fund. They paid for merchandise to be delivered and a customer's package to be delivered. And they purchased office supplies that were immediately used. So they had total of $71.30 expenditures in the month of November against their petty cash account. So at the end of the month, they would complete a journal entry for that. They would have that miscellaneous expenses, merchandise inventory, a delivery expense, and an office supplies expense, and then record cash of $71.30. That $71.30 would be put back into the petty cash account to reimburse for the expenses that were taken out during the month of November. If we want to increase the amount of petty cash, we're going to debit petty cash and then credit our cash account. The same thing would be if we want to reduce the amount of cash available in our petty cash fund. There's normally an established amount of petty cash that is available. It's usually not a very large amount, so $50 to $100 would be fairly standard, and it's just to take care of any miscellaneous or small expenses that might happen that we wouldn't want to take the time to issue a check for. But we would need a record or receipt of why this cash is going out and being used. If we fail to obtain a receipt for payment or overpay an amount, then we show a cash over or short for that. So in this example, there's a $7 difference between what we have receipts for and what we have available in petty cash. So that $7 could have been spent on something that we didn't get a receipt for, or it could have just been pocketed. Unfortunately, we don't really know in those cases. Now, this is something that we would want to keep track of because we don't want to see that every month $7 or $7 to $10 is over or short in our petty cash amount because we don't have receipts for it.